Now we pivot to the international market and what are some of the impacts and how that's going to shape kind of what the U.S. is doing on the coast as well. So this was an interesting chart because it shows global cumulative oil demand growth by fuel. Again, I would ignore the million barrels a day number. Like I love how someone had something going out to 2050. It's like we can't even agree on what demand was 2 quarters ago previously, let alone 10 years out. The thing that I do agree with is the shift in LPG and naphtha. For those that have been following us, we've been saying that oil growth is going to be driven by the liquid side, not so much black oil, but the liquids demand and the liquid shift. And I think, this is, I give them credit, the IEA has to put out something. So they try to put numbers to it. Is it a 1.5 million barrel a day increase by 2028? Is it a 2 million? Is it a 4 million? Again, we can't agree on what LPG and naphtha demand was 2 quarters ago. So for me to tell you what it's going to be in 2025, it's going to be an error and I'm going to be wrong. I can just give you direction, and just based on the amount of petchem coming online, the amount of demand for plastics in the future, that's going to be the benefit going forward. But in this kind of is showing you what we've been talking about, where gasoline is going to drift lower, not because of EV adoption. This is more along the lines of just changing structural shifts in the way people work, the way people travel. Inherently, cars get old, the age of cars, when you look at miles per gallon, when the average car in the US is 13 years old. So as we get to 2025, you can see that that's going to pull things forward, and some of the heavier, less efficient engines will drop off. We have a lot of V4 turbos. You have a bit more efficiency pieces, which again will shift things that way. But you can see it's still a rounding error. So one of the things that we've been saying is that it's not that black oil demand is going to fall. It's just going to go sideways. And the demand growth that's going to, when you look at the globe, like when you look at OPEC saying 100 million barrels, only about 60% of that is black oil. 65% of that is black oil. The rest is the liquids front. And the liquids is where, this is showing kind of what we've been talking about. Now, when we start looking at the future, because the IEA, OPEC have also said that things are going to get so fantastic in the second half. But when you think about it, and again, according to OPEC as well, OECD commercial crude and product inventories have increased by more than 200 million barrels since March of 2022. So you've had an increase since 2022, and Chinese inventories are just massive. Something close to 85 million barrels a day, million barrels in storage. And then when you look at Russian exports, they've increased to about 3.2 million barrels a day this past week, up from the previous week's low, which we'll show in a minute. Now, it's still down. It's still lower than what it was previously. Let's say anywhere between 350, 400,000 barrels a day down. But we're up about 100,000 barrels a day of diesel, exports. So yes, crude came down, but diesel went up. And that's the things that we keep talking about when we have to show those different shifts, which is why it's important to look at, Russian diesel. So refined oil exports have gained in July as diesel flows near record highs. So diesel's near a record, if not at a record at this point. So in the first 15 days of July, Russia's refined fuel cargoes rose about 81,000 barrels a day compared with June's total, according to the data by Bloomberg, Vortexa. They're at about 2.5 million barrels so far, heading for a 3-month high amid a ramp up in refinery operations. So refiners are ramping up operations in Russia, so they're going to consume more oil. So oil exports go down, but then they're going to export more products. So again, you're just getting a bait and switch. Now, is it net still down? Yes. But it's important to look at, it's not what it seems on the surface, and that's why we have to dig a bit deeper and why we want to look at, what is happening in the market? You had some nice drawdowns in Singapore, some additional drawdowns in Fujairah. Chinese exports have been slow, which again leads me to believe that there's going to be something. It's just a matter of timing as to when does it come out. There's no beholden side because Russia's doing this because there's great premiums right now. So if you're a Chinese company, I would be hitting this market aggressively given the margins that are out there, because Russia's doing something similar. Shipments of diesel or gas oil, the top export products, rose 8.5% to about 1.27 million barrels a day, that's near the 1.3 million barrels a day seen in March, when flows reached the highest in their history. Daily average flows are so far about 33% higher than year-ago levels. Russia refiners have prioritized production and exports of diesel amid strong profits. So again, the profits are there. It's just, when does China release those barrels to capture that profit? And again, that's why that's kind of the missing piece, because Russia's seeing it. They're exporting more. When you look at the Middle East, they've slowed exports of crude, but increased exports of product with the increase of operation of their refiners, and that's going to be something that we have to watch, continue at this point. So now, when we start looking at some of these key spreads, diesel gas flows hit 4-month high near record levels seen in March. A lot of it is going into other parts of Europe. You're seeing it into Africa. You're seeing it into Asia and the Middle East. Now, the Middle East doesn't need it because they make their own. So if the Middle East is importing it, well, I can assure you it's going into a tank and then getting re-exported to the U.S., to Europe. So we're still importing Russian product. It's just adding a layer and adding a step and just increasing the cost. South America is seeing more. Again, that's putting pressure on U.S. exports, because the U.S. used to export, or does export into Latin America, into Europe. Well, so as Latin America slows down, Europe becomes the main gateway of the export side, which is why exports will slow. But again, the arb between East and West is going to be a big driver in terms of, well, how much goes over there? What are the flows? So the Fortes differential right now is at negative 20 cents. So it's 20 cents below dated Brent. In a tight market, this is coming from Big Oren, for those that follow him, because he does a good job of breaking down the physical. In a tight market, he's saying that he would expect Fortes to be over $1, maybe closer to $2, which we've seen in the past. The rest of the BFOET crudes, also much lower than normal, should be at least $2 more in a tight market. Now, it's interesting because it's still tight. It's not like Fortes differentials at negative $1, negative $1.50, which we've seen. It's come down. It had a nice spike. Now people are starting to look at where there's opportunities, starting to readjust. The med crude differentials, such as Saharan blend, much lower than a tight market, at least $2 lower than what a tight market would be in the West Africa. Crude is stronger, but still at least $2 lower than what we've seen when things have gotten tight. So they're better, and this is the key thing. They're better than they were when you compare it to, the pre-announcement of Saudi, maintaining that voluntary cut into August, but it's not where it has been. So you had this big, nice spike, and now things are coming down. They're coming down above and settling higher than they were, but not at that peak. And again, as things kind of level off, which comes back to our point when you look at the Brent, the futures market. The futures market should essentially be, here. One of the things we were saying, 73 to 78, 77, 78 on an extension. Now we're saying that it's really 78 to 82 on the Brent side. And that increase is reflecting a better physical market, but not a physical market that is so tight that you're going to get these big increases to north of 90, closer to 100. And then as you start to see some of this rollover, in terms of demand, as we keep talking about, we're not seeing summer demand show up the way it has before. As we talked about in the segment before, we're seeing a sizable decline, double-digit decline in hotel stays. We're seeing additional slowdowns in the Red Book in terms of same-store sales, new store sales. You're getting commodity pressure, the official quote-unquote death of the Black Sea deal that put wheat limit up. For those that have been following us on our econ show, we've been saying that wheat was the easiest long on the board because it was only a matter of time. And they've, Russia has continued to hit Odessa, hitting loading infrastructure. So again, there's there's pressure all around, and those increases in grains is going to show up in food. It's going to show up in inflation, and that's why we just don't see this massive second half surge where the industrial side is already slow. You're already seeing high, some of these pressure points on the industrial front in contraction. The sour market is tight though, and that's what we've been talking about. When you look at it, it's when you look at the naphtha crack below the HSFO crack, which we'll talk about in a minute, sour diff is above some sweet diffs, and light market is relatively soft. It's not tight, and that's what we've been saying. It's the sour market, the heavy medium market that is tight. It's going to stay tight. It's not as tight as it was, but it's still better than previous. It's the light side that's continuing to see some of this breakdown, especially when you look at the naphtha, because naphtha, a lot of that goes into petchem, not as much into refining, not as much into petchem as the LPG ethane side. So when you look at naphtha and the movement for octane and topping and some of that other components, just there's not a huge demand given the amount of gasoline that's sitting in storage. So then when you look at Russian naphtha is also climbing. So again, more competition, more of this flow coming out, which is putting that damper and we'll show the chart in a moment, looking at high sulfur fuel oil versus even high sulfur fuel oil, let alone ultra low or low sulfur, as that continues to shift. Seaborne crude, as you can see, it went down, starting to bounce back up. And this is what we've been saying. It'll come down, but you're also seeing the diesel rise. So on a 4-week average basis, overall seaborne exports in the period to July 16th were down by about 105,000 barrels to 3.1 million. This compares with an average of 3.38 million barrels in the 4 weeks to February 26th. And then more volatile weekly flows moved in the opposite direction, rising by about 260,000 barrels a day to the 3.11. So again, you're getting some of this bouncing around, and you're getting more diesel. So if I had to put a number on what those exports look like, it's not a cut of 500,000 barrels a day into the export market. It's a cut of 300,000 because things are now coming back up. On the export side of crude, you have that extra amount of diesel. It's still down, but it's not 500, and there's going to be more pressure coming into the market. Russia's Urals crude slumped back below the price cap as you had some people slow down buying. India slowed, and not because they don't want it. It's just they have enough. They've purchased it. You're seeing a lot of these purchases. You had a lot of purchasing from China, which we'll show in a minute. That will drop back off, and as that does, that pushes things back down in terms of some of those flows. But as you can see, Asia is still the key piece. And this is just looking at Urals, that exit piece. Again, it had that nice spike. You had a lot of those differentials go up. You had a lot of that recovery. And now you're seeing those differentials fall off fairly quickly, still above where we were before at the end of June. But again, not where we were at that peak. And we do expect to see more of that slowdown as the Middle East sees, an increase in floating storage. And this is timing delays. There's a lot of things that come into it, but this is not something that you're going to see in a tight market, especially when we look at West Africa, which priced themselves out of the market quickly because they just gunned diffs. And everyone's like, okay, well, I'm not paying that. I can wait. But, I'll pay higher than it was, but I'm not paying $4 above. Maybe I'll pay $2.50, $2.75, but I'm not paying that $4 above dated Brent. I'll pay $2.25. And that's where you had that big spike, and now it's starting to drop back down. And that's some of that timing, but you can see in terms of against 2023, this is a lot of floating storage to be in the Middle East when you factor in that now we've had 19 days of less than a million of additional million barrel a day cut, with the expectation of additional cuts, but UAE is undercutting. There's more friction between the two that we've been talking about since 2020 that I don't think gets enough press. Well, I should say earlier, because the issues in Yemen were well before COVID. So really, I think the first article I think we did was I talked about it a bit in 2018, but I think I actually wrote about it for Primary Vision clients in 2019. So again, you're seeing that pressure point, which is the UAE is increasing production. They want to continue increasing production, and that's going to be a key piece here. And this is what we were talking about with the naphtha fuel oil. there's a lot of naphtha out there and there's not a whole lot of demand, but there's, not as much fuel oil. There's not as much that heavy. So when you look at the crack spreads, distillate is doing pretty well. And if you can, you're going to try to capture that and not try to capture the gasoline light end, because you're not going to make as much money given some of these underlying backdrops. So then when we start looking at flows from the U.S., we're still at the highs. But as we've been saying, we're going to average that 3.7, 3.8 million barrel a day export level, not where we were previously because of those headwinds. It's still, as you can see, it's still going to be well above historics, but just not where it has been as some of that demand falls off for light sweet. And then when you look at the gas oil in China, in Asia, we're over $20. So again, if you can, it has to go up because they have to afford the additional and be able to purchase the additional heavy sour, but you're being compensated. Storage is still low, and you're still seeing that opportunity, which is going to pull in more of that crude and allow some of these runs to continue to increase, which is going to pull in more of that disty. Dubai Brent, here you can see that we've inverted again. It's down negative 48 cents. And that's where we continue to see these pressure points. That's why we talk so much about what the UAE is trying to do and where, why are you going to go to the Middle East if it's cheaper to buy Brent? And that's some of the pressure points which we've seen, which is why we talked before about Fortes, about some of these key European blends, because they're still cheaper than what is happening in the Middle East. So that's where when you look at it, it's like, well, I'm going to go buy there, but yet diffs have softened. So they're still better, obviously, because I'm not going to buy Middle East. I'm going to go buy up there. And this is going to cause more problems and create more strife and a bit more anger when you start looking at some of the key pieces going into the next OPEC meeting. Asian floating storage has come back down. It's back to where we thought it was going to be, that mix between 2022, 2021. It's going to bounce around at this point in time. We did get some of this coming off the water. And the reason why it's going to bounce is because we got another bid of China's supertankers, picking up additional crude imports. And this is the problem. It's look at how hard they're buying ahead of what is normally happening. Given 2020 was a special world and special, what happened there. But they're buying aggressively when you compare it to the previous years. And that's not something that is stopping. I mean, it'll come down because seasonally it does, but that's a lot of crude to be pulled in when you still have them running refiners at a fairly depressed run rate in comparison to imports. So at this level, they're still putting over 1 million barrels a day into storage. They're already at 980, 985, which means that at some point they're going to have a pretty steep drop off. And I think that's going to surprise people, quote unquote, surprise people when they don't continue to buy at these elevated levels. And not to say that they're going to drop off. They're just come back down to normal. And all of a sudden, you have a lot of this excess crude sitting there. And again, China congestion. We talked about it in the Asia show for the EIA show and the Econ show. We've been saying from the beginning, things are not that strong in China. And that continues to play out. The data continues to worsen. And it's funny because people like to fight us on it. So West Africa floating storage, record high. It took out the 2022 highs. It's the highest in 2023. And remember, they gunned it in terms of spreads. And everybody laughed and said, no, I'm not paying that. And now it's going to start, spreads have already started to come down. You've started to see some more products start to move. We'll talk about that in a minute. And again, it's just because there's a bit more of that appetite given some of the adjustments in price. U.S. crude products and exports, finished gasoline came down a bit, 43,000 barrels, but again, still high against the 5-year. Same with distillate. Propylene came down small, but still well above the 5-year. So again, everything is pretty much in line with what we've been saying when you look at the export levels. So not too much in one way or the other. But gasoline, again, staying high. This should trend down, but you can see it's still going to be well above. We thought it was going to come closer to the 5-year. Instead, it's likely to stay, especially given seasonally speaking, it'll likely set new seasonally adjusted highs over the next couple of weeks. Distillate will just stay at this elevated level. We thought it was going to come back down given the ARB. The ARB was open coming from east to west. That is now closed, which is going to keep this a bit bumped, and that'll stay above the 5-year on average. Crude exports bouncing back up again. Not too much to say outside of that 3.8 million barrel a day flow. Propane, seasonally adjusted at the highs. Again, not changing in general. Ethane. We've gotten a lot of questions on ethane, and John Riley and Greg on the Diff, I think, talked a lot about this in a very intelligent way in terms of opportunities. And it's just there's a lot of ethane exports at this point. You have a lot of ethane crackers that are turning on now. They have turned on. They're currently turning on and will continue to over the next 10 years, as we talked about in last week's episode. And that's going to pull those ethanes and ethane and keep them moving forward. Because natural gas is so low, there's an NGL side. It makes sense to leave a bit more ethane in there. You're not... But here you're going to get paid to recover. You're going to get some of that supply. We do see a glut coming in order to push down pricing. But again, exports are going to stay at seasonally adjusted highs. Setting new 2023 is going to be a new record year for the amount of exports. And that's just because guys have to turn on after spending billions of dollars in CapEx building it. So that'll keep our exports fairly elevated. Now, when you look at flows in Fujairah, you had a big drop in storage. There was a drop of 3.4 million barrels, bringing us to about 16.8 million in storage. That finally brought us below the 20 million barrel mark. The light distillate, it decreased 1.497 million barrels. East of Suez gasoline complex strengthened in early trade as Malaysia picked up a bit more spot. Singapore gasoline exports rose, which also, again, it was what we were talking about. While imports fell almost 20%, pushing net gasoline exports up. So you're seeing some of these underlying pivots. The fall in Singapore's gasoline imports came as China's outflows to the city-state were down. Chinese exports are expected to fall in July ahead of the summer holidays. And again, China's the one that's is continuing to keep that, behind a wall. And we were expecting to see a bit more light distillate come out. So that'll keep things a bit tighter in both Singapore and in Fujairah at this point until we get some of those additional flows. Middle distillate fell 387,000 barrels. The sentiment on Asian ultra low sulfur gas oil was stable. So again, there's some bright spots. There's some issues. There's some decent transaction in Korea. But regionally speaking, China gas oil exports fell in June, but they're expected to see a sizable increase in July. The question is going to be how much and when do they start to really hit? Gas oil exports from China are estimated to be about 1 to 1.2 million tons in July, which is down from the original estimates. So again, historical data, it's going to be interesting. Net, what does that mean? Middle distillate is going to stay tight on a storage level, which is going to incentivize more runs, which will put more product out there. So we could be running headlong into a wall as you get a more and more slowdown in an economic front, and this goes into storage. Heavy resid dropped 1.5 million, but remember, there was a lot of weather. There was some slowdowns on trade. So this is kind of a big makeup number. This will reverse back up just because the trading activity was fairly tepid, and this is a bit of a makeup move as some of the ships showed up. But again, total flows at the different largest bunkering hubs continues to slip. They're down anywhere between 2.5 to 7%, so we don't see too much adjustment there. On the Brent time spread, you can see it's 15 cents. We're moving closer and closer into flat pricing. And again, just as things weaken, as we've been talking about, this is being pulled down a bit more into that backwardation component, into the contango component, away from backwardation. When we look at flows, again, not too much has changed. You had some movements, in terms of numbers wise. As we talked about, Libya took about 350,000 barrels a day of production off, but there was enough of that buffer in storage, so that will, keep things fairly stable on an export level. And then when you look at Nigeria, that is on a bit higher. Angola took things down slightly. September's plan came in at 33 shipments. which has one shipment went from August into September. So again, you had some slippage from one to the other. About 16 shipments of Nigerian crude for August loading are still waiting for buyers, or a third of the 50 that were scheduled. But when you look at July 7th, 80% was unsold because remember, you had all this big news, you had this big spike in diffs. They took diffs higher. As some of the data comes out, I'm sure you're going to see that some of these crudes got sold at much lower prices, or at least weaker prices than were initially pushed. They have improved for West African grades in recent weeks, but again, not like they were, not at those highs. Nigerian crudes are still could also further lift in the Forcados halt proves prolonged. So we also don't know. We're still waiting to hear about the issues that we talked about with Forcados, which is something that we still don't have as much clarity on. 4 to 5 cargoes of Angolan crude for loading next month are yet to find buyers out of the 35 scheduled, which is less than the 8 to 10 unsold as July 7th. That's still a bit slower. We would expect it, again, in a tight market, Angola sells out quickly. So you're seeing some of those slow down. 3 consignments of the Congo crude are still looking for purchase out of 7. That's pretty slow, especially given that China's usually the big buyer. So again, this is what we were talking about, where the market is not as tight because there's a lot of European buyers that would pick that up in a heartbeat, and you're just not seeing that demand level. Norway's Johan trading above $3 premium to Brent, highest on record. Again, that's just people needed a quick adjustment to make up the missing crudes, and there it was. Genscape, as we were saying, we expected crude European storage to kind of flatline and follow some of that seasonal trend. We don't see a huge drop at this point in time. When you look at gas oil had a small drop of 29, gasoline, small drop of 30, naphtha build, but fuel oil, the biggest issues here remain fuel oil and gasoline. As you can see, gas oil remains at a slowdown, which will continue to attract some of those additional flows, whether it be from the U.S. and or from the Middle East. Gasoline, again, seasonally adjusted, all-time highs, well above. That's something that we've been talking about, which is why we're going to see more of this come into the U.S. Fuel oil, it just took out the 2020 level. We're still at the tied for the highs in 2023, but you can see that there was that sizable drop that happened in 2020. So seasonally speaking, we're at the highs. This is a problem. Recracking, something that's going to have to be done to manage this, as there's no flow west to east, and a lot of that is because of Middle Eastern flow, Russian flow. Even though the margin, because as we said, high sulfur fuel oil is trading at a premium, but yet this is sitting in storage. So again, it's just because it's out there, but it's being taken by some of these other and areas that can compete more aggressively, not only on shipping, but also because of sanctions. Total fuel stockpiles in Singapore had a nice drop. It's essentially tracking 2022 at this point. We do expect to see that reversal that we saw in the same period, especially as things slow. But that reversal actually happened because of Chinese exports. So we're waiting for something very similar that we saw last year. It's just a matter of timing. When you look at gasoline, had a nice drop, still high in against history. But you can see it's back to where we were in 2021. We do see a bit of a bounce, but not what we had seen previously, unless we get a bigger drop down in demand or a bigger import side. So when you look at, again, when you make diesel, you make 1 barrel of diesel, you inherently make 1.8, 2 barrels of gasoline. So as the disti crack remains supportive, we will see more gasoline or light distillate come into the market. But again, that's going to take some time. And here's where you look at small increase in storage in middle distillate, but still very much on the low end, supporting that crack spread. And then resid continues to kind of bounce up and down. We had some decent loadings after some massive delays from these different hubs. This will just bounce back up to that 17, 19 year average. North Sea starting to see that slowdown again, coming back to kind of Big Orvin's point. You're getting some of that slowdown in buying, a little bit more going to floating storage as people kind of adjust some of their flows. The panic is a bit over. You get some of those diffs soften a touch, and that's what we're seeing here. And then the same can be said in terms of Europe. A little bit of that flat line kind of balancing things out, and we do see this trending a bit higher over the next day or two, the next week or two. So that's what we have for you today. If you have any questions, please let us know. We'd love to hear from you, and we hope you enjoy the rest of your week. Thanks again for watching. I'm Mark Rossano, founder and CEO of C6 Capital Holdings, coming to you from Primary Vision Network.